Scott.
Excited to have another conversation about what's happening in markets. So let's
Always.
start with the Federal Reserve. Soft landing. What's happening?
Well, yeah. Very interesting one, right? Soft landing or something else, recession or higher for longer. This has been like the pinnacle of discussions of anyone who's following markets for the past year. Basically, what we had last week on Wednesday was the FOMC Chairman Powell saying that the Fed is no longer projecting a recession. So there's three basic things, right? That we can three takeaways from that meeting, right? The Fed is no longer projecting a recession, the Fed internal economics team, which is very significant, meaning that interest rates can continue to stay higher for longer. The second of all, if the Fed is no longer projecting recessions, the implication is they're not going to cut rates this year. And the market has been, if you remember, pricing in cuts significantly ever since. I remember in March, just before the banking crisis started, they were projecting that already by June they're going to be down to 4%. Well, it's already August, and they're up at 5.5, right? Highest in the past 20 or something years. And the third thing is that he basically said that if interest rates are not going to go down, and inflation is more likely to stay a little bit stickier, and they're expecting the core inflation rate to go down to 2% by 2025, right? So we're stuck with higher core inflation, right? So remember the difference between core inflation and actual inflation. The CPI that was measured is mostly food prices and gasoline price or energy prices, right? Oil, gas, whatever. Interestingly enough, so typically what we've seen last year, you had the inflation of oil and gas and everything driving up the energy prices and food prices, driving up all other goods and services, and these goods and services are much more sticky and much less volatile, right? So now we have this whole disinflation moment that we talked about last time is driven by a decline in energy and food prices, right? There's still a few challenges on that. People are assuming that it's probably going to start going up again because commodities are back in an upward trend. Oil is going up, so we might see this impact on inflation not being done, and the Fed is very careful to that end. But they're still expecting the sticky part, the core inflation part, to remain above their 2% target throughout next year. Which means essentially, I mean, if you're reading into what they're saying, that interest rates will indeed stay higher. They're definitely not going to go down this year. Probably the next expectation is from the markets, again, which were wrong about the Fed throughout this year. So the expectation they're going to start cutting in May next year. So we'll see if that materializes. So far, thus far, the main conclusion from the Fed with respect to these three things that we mentioned is higher for longer is here to stay.
Mm-hmm. So one of the main concepts that you talk a lot about is this idea of the wisdom of crowds. So if the wisdom of crowds is present in markets, how did the market misjudge this in the way that it did and misjudge the actions of the Federal Reserve?
Yeah, I mean, well, first of all, I think that the markets were so wisdom of crowds is something that we do, right? Obviously, this is our our forte. But wisdom of crowds often do need realignment. That's what the Bayesian is all about, right? So the Bayesian looks at a wisdom of crowds type of opinion, but then it adjusts this opinion based on where you are in your social group, right? Meaning that you're likely to be biased if everyone around you is biased in the same way. That's what we use. That's what we use to correct the wisdom of crowds approach. And I think with our approach in this particular question, we could see the same thing, right? Because you had a lot of market participants saying that the Fed has been wrong about inflation in 2021. This is what was driving a lot of people to fight against the Fed, even though one of the oldest adages in investing is don't fight the Fed, and it was right this year. But basically, but in 2021, the Fed was saying that inflation is transitory. They kept repeating in every meeting. They were saying, we're not going to raise rates. Rates are still at zero. The economy is still, recovering from COVID, and we're going to keep rates zero. And the inflation that we're seeing right now is transitory. And they've been keeping this transitory narrative throughout 2021. the first time that they failed, that they were admitting that they were wrong about that narrative, I think it was either November or October when you had that market reaction. And then in the minutes of the Fed meeting in January, they came out after the December meeting. The Fed was saying, okay, we are faced with raising rates, and this is when the first leg of the crash started in 2022, in January 2022. So I think that based on this recent memory, which is what people typically do, discount less than other historical events. So based on this recent memory where the Fed was wrong, a lot of investors are saying they're going to be wrong again, and they're going to have to cut rates, either because of a recession or because of a soft landing. So these were the two scenarios where rate cuts were happening. But throughout the year, I mean, initially I was also thinking that either we have a recession, and I was giving this a higher probability, and the second most probable scenario was the higher for longer. But now this is obviously the scenario that's materializing, and we're going to see interest rates high this year. The economy is still resilient. The U.S. economy is still resilient. It's still strong, but with high interest rates, it's still it's still a matter of time before we see the final impact on markets.
Okay, so do you think, based on what the Fed Chairman Powell said regarding rates, that you mentioned you don't think that they will decrease those rates anytime soon? Do you think that there will continue to see an uptick in rates, keeping them high, but maybe even go a little bit higher to still continue to curb inflation? Is that the expectation of the markets, or do you think we're in a holding pattern for the time being?
Well, it's hard to say, but I think like a little bit of both, right? So in a sense, in terms of a holding pattern, yeah. So the Fed has probably announced that this is going to be the rate they're going to stick to throughout this year. We could see another hike. I mean, the market is not pricing in, and that's definitely. So in our newsletter, you can see the probabilities of. So there's one table that mentions all the probabilities of the Fed hiking or not by the end of this year. And the highest probabilities are that it's going to stay at 5.5% until December, and probably until like mid next year when it's going to go down. So there's no pricing in of higher rates at this point, which can change quickly, right? And this is the type of catalyst that we're waiting for, that we're looking for, either Jackson Hole in August or sometimes in September, where the Fed might say, so for example, this might be a scenario, right? We're not sure, but we'll see. So the commodities prices that I mentioned. So if you look at the technicals of commodity indicators, they're all basically pointing upwards. Oil prices as well, they're over $80, I think, at this point. And this could drive another leg up of inflation, meaning that if we stop the whole disinflationary trend and start seeing inflation marginally go up, it's going to spook markets a lot, because it's going to signal that the Fed is probably going to hike even more, or at least keep rates very high until this inflation is taken under control. But with the Fed, especially, you need to look at the core inflation prices, right? Which are still, I mean, they're going down as well. If you look at the trends, it's also coming down, but it's still 4.5% or something like that, right? And that's still a long way to go from 2%, which is the long-term target. And the Fed itself is projecting that 2% is not going to happen until 2025. So for the entire next year, we could stick with rates being very high for very long, and this is going to imply that we're going to have 2.5 to 3 years of very high interest rates, which would be unprecedented for an economy to survive and go to a soft landing scenario if you have interest rates so high for so long. Because eventually it affects the economy, right? It affects housing, it affects consumer spending, it affects disposable incomes, it affects a lot of things, right? Whenever interest rates are high. So far, the economy has been doing incredibly well, incredibly resilient, and that's been also another driver of the potential bull market. So what you have now is actually a kind of this perfect balance. So you had a lot of people that are bearish. I was bearish we were bearish at the fund for a very long time this year. But now, short term, we're bullish simply because of earnings going well for most companies. You see these reactions on markets. You see these technicals driving markets up, and you really cannot be bearish in the short term. But we're always waiting for that catalyst, that potential event or potential thing that's going to keep driving markets down, or at least drive the next leg of the market down. It could be inflation resurfacing and the Fed saying we need to be even more serious, we need to hike even more, that's going to send the markets into another leg down. If this doesn't happen, if inflation keeps steadily declining and the commodities impact is negligent, then we might, the soft landing scenario is going to it's going to be, the probability of a soft landing scenario is going to go up, and then we're probably going to discount the recession altogether. But right now, I can't make that call. I don't think it's going to happen.
Okay. Are there any economic indicators that you are watching very closely to either confirm the hypothesis that the Fed has put forward that the inflation numbers are trending in the right direction and the US and global economies are going to continue on this route? Or are there any indicators that you're looking at that either confirm or that potentially contradict what the chairman has put forth?
But that's the fascinating thing, right? So if you look at most economic indicators, typically the indicators that are thought to be as leading indicators among economists, things like building permits, right? Things like housing, right? Things like manufacturing index, production index, PMI, that's that sort of thing. So all these indicators, including, and then you have like an indicator of indicators, for example, the lay published by the Conference Board, the leading economic indicator. All of these are pointing to recession, and have been pointing to recession since, I think, mid last year, or April last year, basically, where you had the inversion of the yield curve. That's another thing. Whenever you had an inversion of the yield curve, the 2-year versus 10-year, and even the 3 months versus 10 years, meaning that you can borrow, so you get a higher yield for a 3-month government bond than a 10-year government bond, and that's wrong, right? That it disturbs your time horizon preferences, right? If you borrow someone money for 10 years, you're expecting a higher return if you borrow someone money for 3 months, especially if you're borrowing it to the U.S. government, right? Which you expect to stick around for the next 10 years and be solvent. So essentially, and you had this situation where the yield curve has been inverted for a year and a half now, right? Sorry, for a year, not a year and a half, year and a few months. And this is going to continue, right? If you look at the bond markets, it's screaming recession. It's been screaming a recession since the past year and a half, but nothing's happening, right? The recession is not there. The labor market is still strong. That's another economic indicator. So you have all these forward-looking indicators that are saying something is brewing. But then if you look at consumer spending, it's strong. If you look at the labor market, it's strong. Unemployment is very low. You don't have any problems there. If you look at things like travel, people are traveling, planes, demand for planes for plane rides, for tickets is incredibly high. Again, we're still seeing that effect of like post-COVID surge of demand, and that's still happening. Not to such an extent as in 2021, but still there is this element. So it's been kind of a strange world that we have in the financial sense, where a bunch of indicators are saying recession, but then the most important things like do people have money to spend? Yes, they do. Are they spending it? Yes, they are. Do they have jobs? Yes, they do. The bottom line is still strong, right? And as long as the bottom line is strong, there's no reason to worry even on the markets. Markets are typically forward-looking, so that's why we're looking at the Fed as a potential catalyst and inflation numbers as potential catalyst, because this is going to send markets down, and this might eventually send the economy down. But it's still not happening.
All right. Well, we'll keep an eye on it. Thank you so much,
Absolutely.
Vuk. Really appreciate your insights and looking forward to talking again soon.
Sure, man. Enjoy.